those questions later. But let's go ahead and get this kicked off. I'm going to open up my chat screen so that I can see if somebody has a question. Beautiful. Happy New Year, everybody. Welcome to 2021. At least as of last week, seems like a continuation of 2020. Let's see where this ends up. But let me dive in because I have a lot of information to cover. And I want to make sure I make the best use of the time that you guys have so graciously provided to me. So here we go. Let's make my PowerPoint work. What am I going to cover? I'm going to talk about current rates and kind of where we're at. I'm going to talk about where I think rates are going in 2021. I'm going to talk about what I think is going to happen in the economy in 2021. And I'm going to talk about what all of this means for housing in 2021. And then I'm going to cover a couple of extra bonus items. I'm going to talk about where what the cost of waiting is, what it means to you as a home buyer or as a realtor and your buyers on what it's costing them in waiting to make an offer on a home now. And then I'm also going to talk about paying over asking price and giving you kind of analysis of some options to help out when you have to, in a competitive situation, you have to pay over asking price. So that's what I'm going to cover. Let's go ahead and dive in. First of all, an update on the Treasury market. Last week, we've seen a significant increase in 10-year Treasuries and where they're at. If we were to look back just at the beginning of October, middle of October, the 10-year Treasury was at like 0.69 to 0.75. We were around 0.9 to 0.95 for most of December, and we shot way up to about 1.13, 1.14%. Huge increase, biggest increase we've seen in quite some time. Rates are definitely up a lot compared to where they were just 3 months ago. And here's really what happened. It is the election in Georgia last week. And I'll talk more about this. I want to be clear, this is not going to be a political conversation. So I'm not going to talk politics, but I am going to talk about the impact of politics and how that's going to impact the market going forward. And basically what happened last week in Georgia is that the Democrats essentially got full control over all of the decision-making bodies. So they now have control over the House, the Senate, and obviously the presidency. And so that's going to make it easier for them to pass spending bills. They're going to need to issue more treasuries to fund all of that spending. And it is going to be pushing, likely pushing inflation upwards, and that all puts in an upward pressure on treasury rates. So definitely something to be aware of. I talk about, and I've been talking about for the last 9 months, kind of the headwinds of where interest rates are at and where they think they're going. This is a big impact to those headwinds, and I'll talk more about what does that mean specifically to mortgage bonds. So here's the truth. Right now, not a whole lot. If we were to look, I showed you the 3-month chart and it said that we are way up. By the way, guys, this is mortgage bonds. Remember, down is bad, up is good here. It's inverse. In other words, the higher this chart is, the more value a mortgage bond has, and therefore the less interest we have to charge. Again, oversimplifying this, but the truth is we are right now at levels that we had been at the beginning of December. That's it. So even though the 10-year Treasury has gotten worse than it's been in 3 months, we're only back down to the levels that we were about a month ago. So if we were to take away December's improvements, this was all-time lows in interest rates in late December, early January. If you were to ignore that part, rates are still super good. They're just a little bit higher than all-time lows. So something important to pay attention to when you talk to your home buyers, and they're going to see next week, oh my gosh, rates have gone up significantly. They really haven't. They're just a little bit higher than what they were in late December, and they're still super good, especially when we look back 12 months. So remember, up is good for mortgage bonds. This is where we are right here. Guys, we were only better rates in December, in September, and in August. The entire rest of the year, rates were worse than where they are today. So I don't want people over exaggerating. Yes, that is a concern with the bump in treasuries last week, but it isn't translating to a huge bump in mortgage rates. We've seen movements like this, just like we've seen movements at other parts of the year. This isn't something that is a complete game changer. It's just part of the undulation up and down. Now, I will tell you this is a great opportunity for you to remind your clients, or if you're a home buyer yourself watching this on video, you need to remember rates are not going to stay low forever. So buying sooner and even paying a little bit over asking price is more important because the rate has the biggest impact to your monthly payment. If you wait until the prices come down and rates are higher, you're going to pay a much higher monthly payment. And I'm going to show you what that looks like towards the end here when we talk about the cost of waiting and kind of where things are projected to go in 2021. So John, that's all great, but what's the real outlook for interest rates in 2021? Well, here's the deal. Mortgage rates are still higher than they need to be. What we've noticed and what I've kind of shown you guys before is you've got interest rates and then you have the 10-year treasury and mortgage bonds. And you've got banks that are making more profit right now than they ever have in the history of lending. And I've explained this multiple times on my webinars. Go back through my videos if you want to, but I'll give you a brief overview or a refresher right now. This is basically the average profit margin of a bank. And this goes back for the last 3 years. And you see that it's up and down a little bit. And there's a lot of things that change that. Think of mortgage rates like you think of gas prices. Okay, so you've got the gas station down at the corner of your block, and it's a Shell station, and it sells gas at $3.50 a gallon. Okay, if the price of gas goes way down, that Shell station normally is going to drop the price of gas to go along with it. But what if they're the only Shell station for 50 miles or the only gas station for 50 miles and everybody needs their gas? What incentive does that gas station have to lower the price of gas when there's already a line out the door, down the block, and around the corner of people waiting to fill up their tanks? They can't ship the gas in fast enough to sell it to their consumers. That gas station has zero incentive to lower the price of gas, even though the price of a barrel of oil went down. Therefore, the gas station makes more profit. They kept their prices high because there's no point in lowering the prices. Demand is already there. Demand exceeds what they can supply. That's what happened in this 2020 last 9 months to the mortgage industry. Demand far exceeded what we could supply, so the banks are making significantly more profit. That's the cushion between mortgage rates and what they should be. There's a significantly greater cushion. That really is going to come into play when I talk about where interest rates are going to go this year, because I think it's a big piece of the removal of that cushion. Even if 10-year treasury keeps going up, even if mortgage bonds get more expensive, the banks have to keep feeding the machine that they've created. So that's going to make a really big impact, and I'll tie this all up in a nice neat bow in a minute here. But here's what I want to tell you. There are factors that are driving interest rates up, and there are factors that are driving interest rates down. The factors that are driving rates up are stimulus spending. The more money they spend in handing out money for a stimulus, they being the federal government, the more there is a cost to that money. We have to print money. We have to sell treasury bonds in order to raise money to fund the stimulus package. And when you are trying to raise money in a bond market, the rates go up. The same thing with the deficit. The greater the deficit, the more there is in a cost to service that money. And so it's costing the federal government more money. And there's significant inflation concerns. Inflation is already starting to move up a little bit. And if we see inflation move up more, that is bad news for rates, and that will cause interest rates to go up. We also have the economic recovery itself that is a big factor to drive interest rates up as well. So if you've got the vaccine coming out, you've got the hold on one second here, guys. Okay, so you've got the vaccine coming out, you've got people going back to work, they're spending money. That is going to really put pressure on interest rates going up. Okay, the other side of that coin, though, is that you've got these factors that are driving interest rates down, and the biggest one being the Fed's commitment to keeping rates low, quantitative easing. The Fed can pull the trigger on whatever they want to spend to buy mortgage bonds and keep them low. That's what drove rates super, super low back in March. When they spiked real quick and they came back down, it was the Fed buying that. The second thing that's going to keep rates low is the government. When they are servicing all of that debt, they have an incentive to keep rates low because they're the ones making the payment on all of that debt. So they want rates to stay low. Third thing is inflation will drop back down. Once people start working, they're going, it's kind of funny. Most people think that when people go back to work, they're going to have money to spend. They're going to go out in the market and they're going to spend a whole bunch of money and they're going to cause inflation to go up. I think the opposite. I think when people get back to work, we're actually going to have enough goods, enough products, enough services to meet the demand. Right now, we've got a demand of goods and services. People are still spending money. People are getting stimulus money. They're getting, the people who are employed are doing good for the most part. They're spending money, but there's nobody to actually produce the goods because of the shutdowns that have happened. And so the labor force has shrunk. And once we get those people back to work, the prices of some of these products will come down because there's more supply. The final thing is competition among lenders, and I'll talk in a second about that piece and what that's going to ultimately mean. So specifically, where are rates going? This is the part where you can quote me a year from now and tell me whether I'm right or wrong. Here's the deal. I think rates are going to go up in the short term. I think that the uncertainty right now politically that we're dealing with, the uncertainty regarding monetary policy, I think they're starting to move up. I don't know how much that's going to translate to mortgage rates, but I think it's going to move it a little bit upwards, not significantly. How long are they going to stay up is $1 million question. I don't think we're going to see more than 3 to 6 months of rates going up before they come back down closer to levels that they are today. Here's my worst case scenario. My worst case scenario is I see rates at 4%. And if we hit that, it is short-lived. I honestly don't think we're ever going to get there. I think the new high is going to be closer to 3.25%. And here's the biggest reason why. Because the banks have all of that profit that they have been earning. And because they're so fat and happy and they've been making so much money in profit, well, they'll be happy to lower their profit levels back to what's normal. And as a matter of fact, I think they're more than willing to lower their profit levels to skinny margins, or what we had back in 2018, which is called margin compression, where we started really competing for that consumer, and we started really lowering our profit margins to be a lot closer to what our cost of money is in the first place, thinking, hey, we got to do whatever we can to keep the deals coming in the door. The industry in 2020 was on a huge hiring binge. And we have brought in a lot of underwriters, a lot of funders, a lot of doctorars, people that every company is saying, you know what, this bump in interest rates, if it comes, might be short-lived. Let's decrease our profit margin to keep these people employed. Let's not let rates go up very high. I think the magic number is somewhere between 2.99 and 3.25, with my worst case of kind of the 3.5% number. Remember, my true worst case, I don't think it's ever going to hit 4%. But I think that really once banks start getting to 3.25%, the refi business is going to slow down significantly, and it will have some impact to the purchase market. And that's where the banks are going to start squashing or trimming their profits and passing along savings to the consumer to keep that machine rolling. I honestly, guys, don't think, even if treasury bonds go up, which we cannot control, only the government can, mortgage bonds, somewhat within the industry's control, but the big difference is the rate to the borrower. The biggest piece right here is the margin that the mortgage company is earning. And that margin the mortgage company is earning is way up. As I mentioned back here, they're making way more money than they ever had. They have money in the coffers that they're willing to spend to keep this gravy train rolling. So I think that's super, super important to understand. I don't see rates going up higher than about 3.25 to 3.5. That's kind of my high end of where I think they could hit. And I think if they hit 4%, they'll quickly turn around and come right back down. All right, politics. How does that come into play? Here's the deal. This is not a political conversation. You don't know my political persuasion. I don't know yours. I don't care what yours is. I'm speaking on facts. So the fact here is the Democrats have control over the House, the Senate, and the presidency in a week or two. And so what that means is a couple of things. It means more programs. There's a big housing platform that's intended to drive up home ownership rates, and I'll talk more about that in a couple of minutes. But it also is going to mean a lot more spending. The incoming Treasury Secretary is Janet Yellen. Steve Mnuchin is the current Treasury Secretary. He is very anti-spending, and he is basically stopped when the Federal Reserve says, I want to spend money. They've got to go to the Treasury Secretary to get that money. The Treasury Secretary holds the checkbook. So the Federal Reserve says, we think monetary policy should be blank. And in doing that, for example, we want to buy treasuries and buy mortgage bonds. The Treasury Secretary is in charge of the checkbook that says, nope, I'm not going to let you have any money. It's kind of like your allowance for your kids, right? You can't have the money or you can have the money. The incoming Treasury Secretary, Janet Yellen, used to be the chairwoman of the Federal Reserve. Very, very pro-government involvement in monetary policy. You may or may not think government involvement's a good thing, but ladies and gentlemen, we are an industry that is full of government involvement. Okay, Fannie Mae, government controlled. Freddie Mac, government controlled. VA and FHA, government owned. USDA, government owned. So whatever your political bend is and whether you think the government should be involved or not, the truth is for our industry, government involvement is a good thing. And the incoming Treasury Secretary is very bond friendly. In other words, she's going to let them write checks. She's going to let the Federal Reserve write checks that will help keep interest rates super, super low. We expect the Fed to keep buying bonds at similar levels to what they bought in 2020. And here's why that's important. Because the two most recent big spikes in interest rates came from the Fed taking action. In 2013, the Fed slowed down their purchasing of mortgage and treasury bonds. Guess what? Right now, the Fed in 2020 has been buying a huge amount, far more than what they were buying in 2011 and 2012, of mortgage and treasury bonds. At some point in time, they're going to slow down that buying. That's going to be the biggest signal that is going to drive interest rates up. Unless, or in, well, not unless, at some point they're going to, at the point at which the Federal Reserve says we are going to slow down our bond buying, that's when interest rates are really going to start moving up. And I don't think Janet Yellen is going to allow that to happen anytime soon. They're going to keep a much longer leash on this issue, and they're going to allow interest rates to stay low and keep them super low. So we've got to keep our eyes on the Fed to kind of figure out where we're going. So where's the economy going in 2021? Couple of things. First of all, the stock market. So early 2020 was a pullback. We saw it happen in March. COVID became a major problem. We had shutdowns across the country. The stock market was tanking. That pullback, that what they call bear market, so that bear market quickly turned around a month and a half later and has now become a bull market, in other words, moving up. But it kind of pressed the reset button that started a new cycle that had the economy, or not the economy, huge difference between the stock market and the economy. So it had the stock markets really revving, and we had an amazing March through, or April through December has been absolutely amazing for the stock market. The Dow's at all-time highs, and honestly, I still think they're going to go higher. What is different is normally what is good for stocks is bad for bonds. In other words, if the stock market's doing well, mortgage rates are doing bad, and that means they're going up. Right now, we're all operating from the same playbook, and it has to do with Fed intervention. I was watching a couple of I was doing a lot of research today as I was getting prepared for this webinar, and I was watching a couple of videos from some people talking about the stock market, and 3 of the 4 people that were talking about it said, I'm not worried about the 10-year treasury going up, because I firmly believe that before we get significantly higher in the 10-year treasury, the Fed is going to jump in and they're going to start buying even more treasury bonds to drive the treasury rates back down. Everybody is confident that we're going to be backstopped by the federal government, and all of the political pieces are in play to make that happen. So even as we start making a ramp up in interest rates, we're going to see the Fed jump in, as I've been talking about. So we've got a weird situation going on where the news is both good for mortgage bonds and mortgage rates and good for the stock market. And that's very, very uncommon that we have this kind of perfect storm that continues going on even today. My concern, honestly, is a bit of what we call irrational exuberance. This was not Ben Bernanke. This was a guy back in early 2000. I cannot remember his name. Old guy, really, really old guy, Federal Reserve Chairman. Anyway, he was talking about irrational exuberance. And he had said, people are buying for the sake of buying. They're simply afraid of not being part of it. I'm going to miss out because other people are missing out, or other people are getting it, and I want my piece too. And there's a bit of an effect that I think stocks are growing just because stocks are growing. You've got people that are buying stock. You've got Tesla tillionaires, or whatever the heck they call them. People that are now, millionaires because they bought Greenspan. Thank you very much, Eric Allen Greenspan, the balding old man. Anyway, so you've got the stock market going up just for the sake of the stock market going up. That is an accurate statement. and we have a bit of what I'm calling the Robinhood effect. Now, no, I'm not talking about robbing from the rich and giving to the poor. I'm talking about Robinhood, the trading app. Robinhood has created a frenzy of people almost making a game out of the stock market. And that, here's the truth, the stock market goes up as money keeps pouring into the stock market. And apps like Robinhood are adding money into the stock market that are taking people that they could never afford one share of Amazon. One share of Amazon is like $3,500 or something crazy. Not the average Joe can't afford that, but they can buy fractional shares using apps like Robinhood. That allows them to have $100 and buy Amazon with $100 instead of waiting until they save $3,200 or whatever it is to buy one share of Amazon. So is it irrational exuberance? Maybe, but I don't think it's bubble-like. I think it's just a lot more participants that are going in saying, hey, my friend made some money. Let me see if I can do it too. And the truth is that's kind of good for the market. I won't say it's healthy long-term because at some point if those participants pull out, they decide, this isn't fun anymore. I'm going to take my ball and go home. That's when we're going to have to worry because now we got all this money pulling out of the stock market and it's going to cause the market to start really buckling. So really stock market, I think we've got a super strong year ahead of us in the stock market. If you have extra money and you're not planning on doing anything with it, absolutely be investing in the stock market. That's, I can't give stock advice. Past performance does not determine future results. I'm not an attorney. I don't know what things you want me to give as disclaimers, but the truth is the market is a great place for your money if you don't need it in the short term. Where else is the economy going? Well, the thing you got to know about the stock market is fear versus greed. So it was, Eric, you're going to help me with this, but Warren Buffett, thank you. You didn't even help me, Eric, but still, Warren Buffett says, I buy when people are scared and I'm scared when people are buying, or a version thereof. And the CNN Business created a greed index, fear versus greed. And so are people afraid or are people greedy? And this chart kind of goes back and it gives you a rough idea of where we're at. Thank you, Penny. $3,114.21 today for Amazon. So if you have $3,114, you too can have one share of Amazon, or you can go on to Robinhood and you can buy a fractional share. So what this is telling us is, look, early in 2020, everybody was like 100% greedy. Oh my gosh, nothing's going to go wrong. Stock market's great. And then we hit March and everybody's fearful. Oh my gosh, it's bad. Guess what? This was the perfect time to buy. When everybody was afraid and the stock market was falling through the floor, that was the time we should have been buying. Because then as it comes back up, people think their emotions, fear versus greed, is in the rear view mirror. So we've seen at the end of 2020 that the greed index starts going down some and it starts being fearful. That says right now is a good time to be buying. That's not a great time to be buying like last year, but it's a good time to be buying because the fear is starting to come back in. You want to buy when other people are fearful. They started getting greedy again, and now they're starting to get fearful again. So just think about that and think about the economy and the stock market specifically in that light. Economic growth. Guys, economic growth right now, it's all about the virus and the vaccine. The travel and leisure industry, the hospitality industries, that's all going to lag until things open up. But then they're going to lead the economic growth. The pent-up demand of people wanting to get out and travel, people wanting to go eat at restaurants. And no, I don't want to get political about, you can say there's people eating at restaurants today, I know, and I don't care. My point is that the timing of this will drive the returning of the jobs. And maybe I wrote that wrong. The timing of jobs, the timing of the virus and the vaccine specifically is going to dictate when jobs start coming back. And we aren't out of the woods. Last week's jobs report had a significant reduction in the number of jobs. The first time in 6 months that we've seen job losses. So we're not out of the woods when it comes to job growth and recovery. But here's the deal. A strong economy will drive an appetite for housing even more than it is today. And I don't need to tell any of you realtors that are on the call what today's appetite for housing is. It's absolutely huge. So here's the last component. Where is the housing market going in 2021? A couple of components of the housing market. A lot of people are worried about forbearance. John, everybody got a forbearance in March through June of last year, and they're about to come out of forbearance and they can't make their payment. They're going to lose their home and there's going to be a bunch of foreclosures. No, there will not. I told you guys this a couple of weeks ago, or maybe last month. I feel very, very strongly the banking industry is not going to get caught foreclosing upon homeowners who have equity in their home. They're going to do everything they can to give you the time to sell the home. The question is, who's listing the property? So it's an opportunity for you to get that listing, because you're right, that person can't afford the home, but the bank's not going to foreclose upon it unless they sit there doing nothing and hoping things get better. That's the definition of insanity, right? Doing the same thing over and over again and expecting different results. So if somebody is in an equity position and they can't afford their payment and they are in a forbearance, at some point the bank's going to try and modify, and then they're going to end up having to foreclose, but they're going to give you as much time as they can to sell that property so that they're not seen as the big bad wolf coming in and stealing that equity from you. So pay attention to that. Call your clients right now. Get into that conversation in some way about how they're doing, how their job is. Find out if they're in trouble, because if they're in trouble, you need to start talking to them about how to get out of the home and walk away with their equity. What else do we need to know about the housing market? Well, back to politics. Housing programs are going to be the key over the next 4 years. So I did a fair amount of research this morning on Biden's economic and housing policy. The new administration is very, very fearful right now of housing affordability and access to housing. They're one of the first administrations in the last 20 years that actually had a housing policy in place while they were in running for office. So again, I'm not taking any side politically here. I'm just speaking of facts. Here are some of the facts that I pulled out of there. First of all, he wants to do a $15,000 first-time homebuyer tax credit. That sounds great, and if it happens, that absolutely will help us drive even higher demand for housing. The problem is demand requires supply, and that's going to be one of our biggest concerns. But when it comes to the housing market and the demand side of things, man, if they get a $15,000 first-time homebuyer tax credit passed, that's going to be huge. Will it happen? I think it's going to be tough to get through Congress, even with a fully democratically controlled Congress. I still think it's going to be tough because that's going to be a pretty expensive pill to swallow, and I'm not sure if they're ready for that. But here's the deal. I think we're going to see some relaxation of the guidelines from Fannie Mae, Freddie Mac, and HUD. The current head of the FHFA, Mark Calabria, you guys have heard me talk about him so far this year. He's the one that, screwed with the rules, raised the rates on refinances, had major problems with people who were going into forbearance and stuck it to the bank to have to cover that cost. He wanted to remove the government's involvement. But the truth is, Mark Calabria is going to be out because he is a Republican appointee, and replacing him is going to be somebody that's going to be much more friendly to housing. Here's the big one, the really, really big one for the new administration: down payment assistance programs. I fully believe, and in all the research that I've done, we're going to see more down payment assistance programs. How quickly this is going to happen, that's the big question. But I think that we already know who the new HUD secretary is going to be. Her name's Fudge, something Fudge. So Fudge has already said she's very pro-housing, very pro-down payment assistance. The current outgoing head of HUD is actually trying to enact legislation this week that will stop more down payment assistance programs. That's how badly they don't want and don't like down payment assistance programs. The new administration is likely to reverse course and push back on this and have more and more down payment assistance options. If they're trying to create home ownership opportunities, the biggest hurdle to home ownership is lack of down payment. They have to find a way, either through the tax credit, which really doesn't help with down payment. Really what they're talking about doing, there's been some very key economists that advise the incoming president and have been talking a lot about down payment assistance programs and the impact they're going to play. I know I've got a few minutes, actually I know I'm out of time, but I got about 5 minutes left. Hopefully you can hang out with me for an extra 5 minutes, because I know it'll be well worth your time. DACA. DACA is Deferred Action for Childhood Arrivals. It is a program. It's not a loan program. It's a citizenship or path to citizenship for people that came to the United States as a minor, and they were given some citizenship rights. And President Trump had basically said, I don't believe in DACA. He had shut down recognition of DACA from a lot of the loan programs. So FHA doesn't allow DACA anymore. Fannie Mae doesn't allow DACA anymore. I firmly believe that we are going to see DACA coming back to life, not in politically how it works from a citizenship perspective, but the fact that DACA recipients are likely to be able to become to borrowers and be able to borrow money using FHA and other types of tools. Here's the deal, guys. big picture, Democrats are better for housing as they build home ownership rates. Republicans are actually bad for housing. They're against government involvement, and most of our money is coming from the government. So don't bite the hand that feeds you in that regard. Our industry is helped by government programs. So I don't care what side of the aisle you're on or what your political slant is. This is a generalized statement. And Obama was the anomaly. But that's because Obama came into office in 2008. In 2008, the economy was just crashing because of mortgages, because of housing. And so the fact is, Obama had to be critical, had to enact a lot of policies to suppress housing because he was really trying to control the out of control nature of the housing market and specifically of loan programs. But across the board, generally speaking, a Democratic legislature and Democratic executive office is good for home ownership. Housing demand, here's the deal. We got the boomerang generation, the millennials that went to college, they went back home and they stayed in mom and dad's basement because they didn't want to do any adulting. They now want to buy. We've got a good amount of pent up demand from lockdowns, or at least once we're out of the lockdowns. We've got demand that's been created by super low interest rates. We've got a supply shortage that's driving up demand. Historically, after a recession, 3 of the last 5 recessions, housing prices went up significantly after the recession. And one of those 2 times that they didn't go up was because of the 2008 recession that was caused by housing. So clearly it would not have happened. We wouldn't have seen housing prices go up in 08, but that means that 3 out of 4 of the last recessions other than 08, housing prices have gone up, and we're seeing that happen. And I think it's going to continue in 2021. We also have the Teslaonaires, the people who invested a bunch of money in the stock market or a small amount of money in the stock market, and it exploded because Tesla and other companies have just taken off. So they're going to be moving cash out of the stock market and putting some money into the housing market. Plus, we have super low vacancies. I think we're looking at probably 8 to 10% appreciation in 2021. And I'm already seeing it. I'm already hearing stories about significantly over asking price. If I had time, I'd tell you a story about a buyer I knew over the weekend that was looking at a house at $760,000 and $790,000, and everybody was offering $850,000, and the closest comp was like $760,000. So we've got, you know this more than I do. We have a lot of people who are looking to buy homes and very, very little inventory. I think we're about 5 years away from seeing the next real downturn in prices, and I don't think it's a big downturn, but I think this market has legs that will last another 5 years of keeping pricing going up. So now I want to talk a little bit about the cost of waiting. And you can email me and I'll send you a copy of this, but here's a quick breakdown that you can share or look at yourself saying, hey, maybe I'll wait a year. Things are kind of hot. Here's the truth. I think that a year from now, we could easily see rates up 0.5%. That's not a big bump, but that's easily the case. And I told you it could happen even sooner. If you bought today 3.5% FHA, $450,000 home, your rate would be around 2.5% and your payment's $2,605. If you waited a year, prices went up 10% and we had a 0.5% increase in interest rates, your payment would be $3,044 and you'd need $32,000 out of pocket. So you need an extra $3,000 out of pocket and an extra $400 a month if you waited a year, assuming rates only went up 0.5% and housing prices went up by 10%. But here's another way of looking at this. You say, fine, John, fine, I'll buy today, but I can't find a home. I have to pay over asking price. So I added a couple of chart options in the middle here. Same first scenario buying today, same last scenario buying in a year with a 10% increase in price. But this one says, hey, buy now and pay 5% over the asking price. The truth is I think prices are going to go up closer to 10% in the next year. So paying 5% over the asking price right now is a great deal, especially because you still have super low interest rates. So you're paying about $130 a month more, and you're able to get into the house. And there's something wrong with my calculations because this should be $29,000, not $32,000. So you're paying about $1,000, $1,500 extra out of pocket. Again, I apologize, something happened with this chart, but if you look on the prior screen, it says 29,000. That's what it should say is 29. But you say, John, the problem is the appraisal. What if the appraiser comes in at 450 and I don't get the 5% over asking price? You can use down payment assistance to cover the shortage. So in this case, I'm using Cal HFA, which is the maximum amount of down payment assistance. You're getting, I think, $25,000 worth of assistance. It is covering a large portion. I know that you raised the price by $22,000. You're saying, well, John, you're giving me $25,000 in assistance, so I should need less money out of pocket. Not true. Down payment assistance loans come with higher fees. So the truth is, you're coming up with about $34,000 out of pocket instead of 31,000, almost 32. So you got about $2,000 extra out of pocket. But this assumes the house appraised at 450, and you bought it for 472. You're only bumping your out of pocket by $2,000. Your monthly payment, you're at a 2.75% interest rate, and so. Guys, there's something skewed about my numbers, and I apologize, but I'll get these corrected because clearly the payment should be higher on this one. So I apologize. I can get these numbers out to you later, but this clearly didn't. I was doing it right before I got onto this call. So bottom line is there are ways we can use down payment assistance. Your payment is going to be higher using down payment assistance because you've got higher interest rates, but it can cover a majority of an appraisal shortage if you came in low. So it can give you some confidence if you need to go into a buying situation where you're worried about the comps. I'm finding appraisers are finding ways to make the comps work. I had one, a property that was $50,000 above the most recently sold similar home. It was the house next door, sold 6 months ago for $50,000 less. And I got an appraisal. It was in Lincoln, and I got an appraisal at the contract price. And we had to do an appraisal review, and the appraisal review still came back at the contract price, $50,000 over what the model match next door had sold 6 months ago. So a lot of great opportunities. The last opportunity I'll tell you is to join me this Thursday. I'm going to go back to doing my webinars. This is a first-time home buyer webinar. If you've got somebody thinking about buying a home and they don't understand how all this works, they need to join me this Thursday at 5:30. The registration link will be at rsvpwithjohn.com. That link will be active tomorrow morning, so it is not active right now. But go to rsvpwithjohn.com, register for this Thursday at 5:30 to be a 1-hour webinar, and it is realtor friendly. I will not be your clients won't be lost to another real estate agent. I won't allow realtors to pitch themselves. I'm simply educating them on the market and what's going on going into 2021. So I really appreciate you guys. I apologize I took a little bit of extra time. If you have questions, feel free to post them into chats. Otherwise, I hope you have an absolutely amazing day. And if you want those numbers on the cost of waiting, once I get it fixed, shoot me an email, and I'm happy to send it over to you. All right, guys, if you don't have any other questions, have an absolutely amazing day, and we'll talk to you later. Bye-bye.